It's a new month here at Henssler Financial, and we found 3 important things to focus on in the market this month. Number 1, earnings season. We're about halfway through fourth quarter earnings season at the time of this recording, and what started off as a surprisingly strong earnings season has started to show cracks. Coming into 2023, Wall Street estimates for fourth quarter earnings growth stood at 4.4%, while sales were expected to grow by 11.7%. But so far, fewer companies than usual are beating Wall Street estimates. Here we are halfway through S&P 500 reports, and earnings have actually declined by 3.12%, while sales have grown by just 5.18%, both well shy of expectations. Should this trend of declining earnings persist through the rest of earnings season, that would mark the first year-over-year earnings decline since the summer of 2020 when the COVID-19 pandemic gripped the economy. So far, for the S&P 500 companies that have reported their quarterly results, 70% had per-share earnings above analyst estimates. That percentage is below the 5-year average of 77%. Number 2, Fed Watch. In what was little surprise to financial markets, Fed Chairman Jerome Powell announced a quarter percentage point increase to the Fed's benchmark interest rate on February 1st and provided little indication that the policy-setting body was near the end of its hiking cycle, despite many pundits forecasting that this could be it. With the Fed funds rate now at a target range of 4.5 to 4.75%, its highest level since October 2007, the Fed has hiked 8 times since it embarked on its tightening path back in March of 2022. In the press conference that followed the announcement, Chairman Powell noted that inflation had, quote, eased somewhat but remains elevated, and went on to say that there was still a need for ongoing increases. Just 1 month ago, the implied probability of a March quarter-point rate hike was just 66%, but following Chair Powell's comments, the likelihood has since soared to nearly 97%, with the odds of a May hike also jumping from 37% to now 69%. In all, the takeaway remains that the Fed is committed to tighter policy and likely has the cover to continue its hiking cycle as economic data remains generally strong. Number 3, China. Reopening euphoria has driven Chinese stocks higher, and this could be one of several reasons that explain the recent stock market surge in U.S. markets, as improving data in China could help buoy earnings of U.S. companies. Recent data over the Lunar New Year holidays show consumers are venturing out more as the government pares back its long-standing COVID policy restrictions, and recent economic data further reinforces this notion. At the same time, however, U.S. and China relations soured a bit after the U.S. shot down what is reported to have been a Chinese spy balloon. A spokesperson with the Chinese Defense Ministry said in a statement that China had reserved, quote, the right to use necessary means to deal with similar situations. While likely not reacting solely on this news, Chinese markets were among the worst performers in the first trading day following the downing of the balloon. Regardless of the cause of the market sell-off, we will continue to keep a close watch on both Chinese economic data as well as any development in U.S. and China relations. That has been your Market Minute for the month of February. Thanks for listening.